If you sell your home after losing a spouse and you wait too long, the IRS will tax you on every dollar above $250,000 in gain, even if you lived in that house for 30 years and never thought of yourself as wealthy. That number, $250,000, is not a rumor. It comes directly from Internal Revenue Code Section 121, and it is the exact line where a surviving spouse's tax protection ends if they miss a 2-year window. I want to tell you what that window is, how to protect yourself before you sign anything, and what to do if you already sold and nobody told you about this. My name is William Hayes. For more than 20 years, I have helped retirees deal with the IRS, the county assessor, and the rules that decide how much of their own money they keep. I am an enrolled agent. That means the IRS licensed me specifically to represent taxpayers, people like you, in front of the agency. I am not selling anything. I am not affiliated with any government office. I sit across the kitchen table from people who got a bill they did not expect, and we figure out together what can still be done. Today's topic hits close. I have reviewed more home sale returns for retirees than I can count, and I can tell you that the Section 121 rules are among the most misunderstood and most expensive to get wrong in the entire tax code. The people getting hurt are not careless. They are careful, responsible homeowners who simply did not know about a rule that the IRS does not advertise, and that most real estate agents have no reason to bring up. So stay with me. This is one of those videos where the 15 minutes you spend watching it could save you tens of thousands of dollars. If someone you know just lost a spouse and they own a home, send this to them today. That is the most important thing I can ask. Before we go further, subscribe if you have not. Every week I bring you the rules that the agencies assume you already know. They do not send a reminder. We do. Now, 2 myths. I hear them constantly, and both of them will cost you money if you believe them. The first myth is this: the home sale tax trap only affects wealthy people with expensive houses. I hear some version of this every month. Someone says, "William, my house isn't worth millions." Here is the reality. You do not need a mansion for this to matter. You need a house you bought 30 or 40 years ago in a neighborhood that grew. That is most of the country. A couple who paid $80,000 for a home in 1988 in a mid-sized city, Columbus, Tulsa, Richmond, take your pick, may be sitting on a home worth $400,000 or $450,000 today. Their gain is $320,000 to $370,000. As a married couple, they are covered by the $500,000 exclusion and owe nothing. But the moment one spouse dies and the other waits too long to sell, that same home, same neighborhood, same driveway, now exposes $70,000 to $120,000 in taxable gain. At a 15% long-term capital gains rate, that is $10,500 to $18,000 handed to the IRS. On a house the family lived in for decades. Also wrong, and this one actually makes people give up before they understand their options. The stepped-up basis rule, which I will explain in detail in a moment, can reset your cost basis to what the home was worth the day your spouse passed away. If values have climbed steeply in recent years, that reset alone may wipe out most or all of the taxable gain. I have seen it erase $200,000 in gain overnight, legally, completely, with the IRS's full blessing under Section 1014 of the tax code. Both myths lead to the same result. People either panic unnecessarily or do nothing when action is required. Neither outcome protects your money. Now let me give you the actual rules. Gov gives every eligible homeowner the right to exclude a portion of the gain from the sale of their primary residence. No tax, no form, no application. It is automatic if you qualify. For a single filer, the exclusion is $250,000. For a married couple filing jointly, it is $500,000. Those numbers have not changed. They are the law. To qualify, you must meet what the IRS calls the ownership test and the use test. You must have owned the home for at least 2 of the 5 years before the sale, and you must have used it as your primary residence for at least 2 of those same 5 years. The 2 years do not have to be consecutive. They can be mixed, but they must add up to 2 years within that 5-year look-back window. Now here is the rule that most people, including many real estate professionals, do not know. When a spouse dies, the surviving spouse has exactly 2 years from the date of death to sell the home and still claim the full $500,000 joint exclusion. This is written into Section 121 of the Tax Code, subsection B, paragraph 4. The surviving spouse must not have remarried before the sale date. The ownership and use tests must still be met. But if those boxes are checked, and the home is sold within 2 years of the spouse's passing, the full $500,000 shield is still in place. Wait 2 years and 1 day? The exclusion drops to $250,000. The rest of the gain, everything above that line, is taxable. For a home with $400,000 in total gain, that is a $150,000 difference in taxable income. At a 15% long-term capital gains rate, which applies in 2026 to single filers with taxable income between $49, $451, and $545, $500, that is $22, $500 in additional federal tax that did not have to exist. In some states, you owe state capital gains tax on top of that. Now let me explain the stepped-up basis, because this is the other half of the protection, and it works whether you sell quickly or not. Under Section 1014 of the Internal Revenue Code, when a person dies, the tax basis of their property is reset, stepped up to the fair market value on the date of death. This matters enormously for a long-time homeowner. Say a couple originally paid $100,000 for their home in 1990. By the time the first spouse passes away in 2023, the home is worth $380,000. In a community property state, California, Texas, Arizona, and several others, both halves of jointly held community property receive the full step-up. The new basis for the entire home is $380,000. If the surviving spouse sells at $400,000 the following year, the gain is only $20,000. The $250,000 exclusion covers it entirely. Zero tax. In a common law state, most states, only the deceased spouse's half receives the step-up. So the basis on half the home resets to the date of death value, while the surviving spouse's original cost basis remains on the other half. The math is different, but the benefit is still significant. Here is the detail that most people miss entirely. Home improvements raise your basis. A new roof, a kitchen remodel, an addition, a deck, a new HVAC system. These are not repairs, they are capital improvements, and the IRS allows you to add their cost to your original purchase price when calculating gain. If that couple paid $100,000 in 1990 and added $60,000 in improvements over the years, their adjusted basis before any step-up is $160,000, not $100,000. That directly reduces the taxable gain. Keep every receipt. Keep every contractor invoice. Keep the permits if you pulled them. I have seen people recover $30,000 in taxable gain just by digging through a folder of old invoices they almost threw away. And one more thing on the basis step-up. You need a formal appraisal as of the date of death. Not a Zillow estimate. Not the county assessed value. A licensed appraiser producing a formal written report, documenting the fair market value of that home on the specific date your spouse passed. This document becomes the legal foundation for your stepped-up basis. Without it, you are guessing, and the IRS does not accept guesses. I want to tell you about a man I will call Frank. This is a composite based on situations I have seen in my practice. Not a single real person, but a real pattern that plays out more than it should. Frank was 71 years old, retired, living outside Pittsburgh, Pennsylvania. He and his wife had bought their home in 1986 for $92,000. She passed away in the spring of 2019. The house was worth roughly $310,000 at that point. Frank was not in any rush to sell. He had no plans to move. He stayed through the pandemic, watched the neighborhood change, and in the summer of 2022, 3 years after his wife died, he sold the home for $415,000. His total gain was $323,000. He subtracted his original $92,000 purchase price and arrived at that number. He knew about the $250,000 exclusion for single filers, so he figured he owed tax on $73,000. At 15%, that was roughly $10, $950. What Frank did not know: 2 things. First, he had missed the 2-year window. Had he sold before the spring of 2021, within 2 years of his wife's death, he could have used the full $500,000 joint exclusion. His entire $323,000 gain would have been excluded. Zero tax. Second, he had never gotten a date of death appraisal. His wife's half of the home should have received a stepped-up basis to its fair market value in spring 2019. At $310,000, her half was worth approximately $155,000. His half of the original cost basis was $46,000. Combined adjusted basis with the step-up, around $201. 000. His actual gain, $214,000, not $323,000. Even as a single filer with the $250,000 exclusion, his corrected gain of $214,000 was fully excludable. He owed nothing. Frank paid $10, $950 he did not owe, plus interest on a late corrected return, because nobody told him to get an appraisal and nobody told him about the 2-year window. What Frank should have done, the moment his wife passed, he should have called a tax professional, ordered a date of death appraisal, and understood exactly when his 2-year window closed. That call would have cost him a few $100s. The silence cost him thousands. Here is where it gets more complicated and more hopeful. If you are Frank or someone in Frank's situation, the story may not be over. The IRS allows you to file an amended tax return using Form 1040-X. You have 3 years from the original filing deadline to do this. If you filed your return for the year you sold the home, and you later discover you missed the stepped-up basis, you may be able to go back, correct the basis calculation, and claim a refund. This is a real option. It requires documentation, that date of death appraisal, those improvement receipts, a clear paper trail. But the IRS does accept amended returns for basis corrections. I have filed them. I have gotten refund checks for clients who thought the money was gone forever. There is also a process sometimes called a look-back, which is the informal name for reviewing the original cost basis the estate used when the property transferred. If the estate filed a Form 706 estate tax return, the values reported there may help you establish the stepped-up basis after the fact. Even without a formal estate return, most estates under the filing threshold do not file one. A properly documented appraisal from an appraiser who can establish historical fair market value as of a past date is often sufficient. The 3-year window matters. If you sold your home in 2023 and filed that return in April 2024, you have until April 2027 to file Form 1040-X. If you sold in 2022, your window may be tight. Do not wait. The refund that exists today is gone if you miss the deadline. And I want to say this directly. The IRS is not going to call you and remind you that you overpaid. The system assumes your return was correct. If you want the money back, you have to ask for it, with the right form, before the clock runs out. Here is what I want you to do this week. Not eventually. This week. Step 1. If your spouse has passed away and you own your home, call a tax professional before you do anything else. Before you call a real estate agent. Before you get a market analysis. Before you decide on a listing price. One phone call to an enrolled agent or CPA can tell you exactly where you stand, what your basis is, when your 2-year window closes or already closed, and what your exposure looks like. That call is worth every penny. Step 2. Order a date of death appraisal if you have not already. Find a licensed appraiser in your area and ask for a retrospective appraisal as of the date your spouse died. This is standard work. Appraisers do it regularly. The report they produce is the legal foundation for your stepped-up basis. Step 3. Pull your home improvement records. Go through old files, bank statements, contractor invoices, permit receipts. Write down every significant improvement you made to the home. Not repairs, improvements. A new roof, an addition. A full kitchen or bathroom remodel. A new HVAC system. Each dollar of legitimate improvement cost raises your basis and lowers your taxable gain. Step 4. Know your 2-year window. If your spouse passed away more than 2 years ago, that particular protection is behind you. If it is within 2 years, it is live. Do not lose it without understanding what it is worth to your specific situation. Step 5. If you already sold and think you may have overpaid tax, talk to a professional about filing Form 1040-X. Bring your original return, any basis documentation you have, and any appraisal or improvement records you can find. The question is whether a corrected return would produce a refund. You will not know unless you look. And if cost is a barrier, if you are on a fixed income and a CPA feels out of reach, look into two free programs. The first is called TCE, Tax Counseling for the Elderly, an IRS-sponsored program for taxpayers 60 years and older. The second is AARP Tax Aid, which provides free tax preparation assistance at thousands of locations nationwide, staffed by trained volunteers. Neither program will handle a complex amended return, but they can point you in the right direction and help you understand whether your situation warrants a paid professional. These programs exist. Use them. This is general education, not personal legal, tax, or financial advice. These rules really do vary by state and by income. Always confirm your own situation with your county, your state SHIP office, the IRS, or a qualified professional before you act. Being legally entitled and actually having the money are two different things. The only bridge between them is the form, and the agencies are not going to build it for you. So we will. If you found this useful, share it. Someone you know right now is sitting on a house, grieving a spouse, and has no idea this 2-year window exists. Send it to them today. And, next, I'm going to show you the one Social Security Administration form that can add 32% to your Social Security check, permanently, and that most beneficiaries have never been told about. That video is next.